In the complex world of finance, one fundamental relationship that often causes confusion is the one between bond prices and their yields. This image uses a simple analogy, a seesaw, to help us visualize this crucial concept. First, the basics. What is a bond? Think of it as a loan an investor makes to an entity, whether it's a government or a corporation. In return for this loan, the issuer promises to pay a fixed interest rate, the coupon rate, over a specific period, and then repay the principal amount, the face value at the end of the term, known as maturity. Now, the key relationship. Prices and yields move in opposite directions. Just like a seesaw, when a bond's price goes up, its yield goes down. And when the price goes down, the yield goes up. The yield, essentially, represents the return an investor can expect to receive from the bond, considering the price they paid. The most influential factor in this dance of prices and yields is the prevailing interest rates in the broader market. Let's look at two scenarios to understand how this works. Scenario 1. Interest rates rise. Imagine you hold a bond that pays you a fixed 5% per year. However, overall market interest rates rise, and new bonds are now being issued, paying 6%. What happens to your bond? It becomes less attractive. Demand for it decreases, and consequently, its market price falls. For example, the price of your $100 bond might fall to $95. It's important to note, it still pays the same $5 in interest annually, but for an investor buying it now at $95, the effective yield is higher. $5 divided by $95 gives a yield of 5.26%. So to remain competitive, the price dropped, causing the yield to rise for the new buyer. Scenario 2. Interest rates fall. The reverse situation. You hold your 5% bond, but market interest rates fall, and new bonds are paying less, perhaps 4%. Suddenly, your 5% bond becomes much more appealing. Demand increases, and its price goes up. The market price might rise to $105. Again, the bond still pays the same $5 per year. However, for the investor paying $105 for it, the yield is now lower. $5 divided by $105 results in a yield of 4.76%. The price rose, pushing the yield down for anyone buying at this higher price. In summary, this seesaw relationship between bond prices and yields is directly driven by fluctuations in market interest rates. When rates rise, existing bond prices fall, and their yields increase. When rates fall, prices rise, and yields decrease. Understanding this inverse dynamic is essential for any investor navigating the bond market.